Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Jared Blikre, your host, and with me is Yahoo Finance senior reporter Allie Canal, who's here to help us color inside the lines in this very wonky field that we call finance. And this week, we've got Powell and the Fed in focus with Jackson Hole, which we're going to dig into. Meanwhile, the markets are still close to records, but we've seen some weakness recently in tech. And this leads to our word of the day, rotation. What's hated becomes loved, what loved becomes hated. Why the godfather of technical analysis calls it the lifeblood of bull markets. And this episode is brought to you by the number 7. That's the number of Jackson Hole speeches that Jay Powell has delivered so far in his career as Federal Reserve Chair. And his swan song this year will cap that at 8. And today we are welcoming back Steve Sosnick, who is the chief strategist at Interactive Brokers, where he analyzes markets for professional and retail traders alike. With decades of experience spanning options, equity markets, and global macro trends, Steve brings a sharp eye to market psychology. His Traders Insight columns are widely read for their candid and often contrarian take on what really drives investors' behavior. So it's great to see you. It's great to see you here, Steve. Let's dig into what's been happening since the last time you were on, because that was in March, and we had a little thing called Liberation Day.
Yep. And
what do you think of the markets right now?
Well, to me, the key to the market so far has been just the resilience and the buy the dip strength that's been coming in. I mean, basically, obviously, what we saw in late March and early April was kind of the mother of all dips, because we did get into bear market territory very quickly. But since then, we've seen traders just relentlessly buying every dip, and to a point where I would say the markets have a bit of a ratchet effect, where at least in the last few weeks, you've seen big moves up and very small moves down, which to me was indicative of nobody wanted to miss a buyable dip. Therefore, they either A, weren't selling, or B, were so quick to buy that dip that it never really occurred.
And that leads to our word of the day here, which is rotation. When we have a dip, guess what? We see movement of money invested in stocks from one place, and you can think sectors here, industries or entire asset classes, to another place as investors anticipate either the next stage of the economic cycle, or they just want to shift money around to whatever's hot and maybe get in at better prices. How do you think about market rotation?
Well, in its basic form, it's pretty benign, right? I mean, it's buy low, sell high. So you're buying something that's relatively low and you're selling something that's relatively high. If it were only that simple all the time, a lot of times what happens is sectors become very much in demand or very dominant, and that's clearly been the case with big cap technology
AI,
recently. Sure. Anything AI related, anything tech related, the bigger the better, so to speak. And so what we've seen here is a little bit of movement away from some of those high flyers, which have come to dominate the indices. And the problem is, because they so dominate the indices, if you get a bit of selling, a little incremental selling in things like Microsoft or NVIDIA or those kind of names, it has a disproportionate effect on the indices. So, you can see people moving out of these tech names. And yesterday, by midday yesterday, it got a little worse in the end of the day, but around midday, you only had 3 sectors lower, 2 of which were telecommunications and technology. And even after the initial sell-off this morning, and again, we're on Wednesday, it had recovered to that, and it was basically telecommunications, technology, and today it was consumer discretionary, thanks to
Amazon, Tesla.
Target also was the key there.
How do you explain to investors that this is a healthy thing for the bull market, especially since you have a lot of retail traders and even on the institution side that are overweight in tech right now, that are probably looking at their portfolios, scratching their heads, thinking, wait, how is this good for me? So how would you explain that?
It's an insult. This is healthy. Right. I'm losing money here.
Well, and therein lies the problem when sectors get so crowded, because crowded trades have a way of being punishing, and they're disproportionate. It's the same thing anytime you have too many people trying to rush for the exit of something, people are going to get trampled. And that's kind of what's happening here is, on the other hand, step back and think, if you've owned some of these stocks for a period of time, you are doing so well. If you can't cope with a 1 or 2% drawdown, or maybe, something a little bit bigger, well, then you're carrying too much risk, and you really do need to think about what you're carrying, and you probably do need to be rotating. So yeah, it stinks, but you can't just look at this day to day. You have to look at it with a broader perspective and say, okay, if in general, and I say this, I preach this all the time, if you're overly concerned about relatively minor moves, then you're carrying too much risk. And therefore, you should be rotating into, either out of these winners or into something
cash,
a bit more defensive, or cash, especially with interest rates still at 4%. You're getting paid to keep money in cash, although it's not going to go up. It doesn't have the potential to rise like some of the stocks do.
And I'm looking at shares of Palantir down again today. We closed down 9% yesterday. And it was interesting because I went out to Vandatrack Research, which tracks retail trading. And there was aggressive dip buying yesterday, yet we still closed down 9%. So how do you look at retail traders versus institutions, and how even if you see that buy the dip mantra, that doesn't always translate to the stock price?
That I love that question, Allie. And the reason here is, retail has gotten to be such a huge percentage of the market, but it's in terms of the day-to-day. But if an institution decides to, if a series of institutions decide to reallocate their portfolio holdings, it's kind of you're standing in the way. You're standing in the way of a larger piece of momentum. Somebody much bigger than you. They're pushing one way, you're pushing the other. If collectively, a whole lot of small people can push back, but if they're really relentless about the selling, it's going to move the market lower. And again, Palantir was a shocking move down yesterday. On the other hand, it's been a shocking move up. And so a lot of people have benefited from this. Yes, it moved back, it fell 9% yesterday. That's clearly a bit of an eye-opener. But if you look fundamentally, Palantir is about as expensive of a stock as we've seen.
Like Amazon 10 years ago, maybe.
Yeah. Now, could Palantir grow into that valuation? I'm not going to say no. And certainly they've got, to a certain extent, the government on their side, because they've been picking up a lot of government contracts. And I think that's provided some of the momentum. But when you're relying upon momentum, momentum works both ways. And so things that have positive momentum on the upside, things that have volatility on the upside, I guess here's actually where I'm going to step back. Volatility is agnostic of the move.
Very good point.
Volatility measures if you go up 2% or down 2%, that's volatility. If you go up 2%, that's what I like to call socially acceptable volatility, because everybody likes that. If you go down 2%, it's plain old volatility. And I think we've benefited in the case of Palantir and so many other names from the socially acceptable volatility that we've kind of forgotten that volatility is a two-sided coin, and it works for you and against you depending on how you're positioned.
We have some socially unacceptable volatility in the markets right now. We're kind of chalking it off to market rotation. I don't think any of us here is raising a red warning flag, but at what point does it get orange? What does it take to get red here? And you can talk about other markets that you watch too.
Well, I mean, I think, when I look at how the market reacted this morning, I think, the market was sort of treading water to a certain extent, slightly lower in the pre-markets, and then 8:32, you can track it to that. And when the president put out his Truth Social post about asking for Lisa Cook's resignation or demanding Lisa Cook's resignation, I think before that the market was content to sort of let the process work out. Because I'm not going to opine whether I have no idea if she did or didn't do what she's alleged to have done.
But we can game that out too. We're going to talk about the Fed after the break and all that good stuff.
We can game that out. But the point being, I think the market was, okay, you know what, there may be some politics involved in the investigation. There may not. Let's let the thing play out. But as soon as you have the specter of presidential interference in the Fed, that gets people spooked, particularly foreigners. And so it's no coincidence that, we sank very quickly after that. We've since recovered a fair amount of it. Jared, I know you're a technician. It was NDX, SPX was right off that 2 standard deviation Bollinger Band, which has proved to be a very, very tight rate. It's really contained the markets to a large extent. Even in April, it contained the market, except the the band was incredibly wide. So that was sort of the more rational dip buying today. And then we went back to rotation, having had a little bit of a risk-off moment this morning.
Yields, though, not doing much at all. I mean, 10-year and 30-year
What do you think
are
about the
still
bond
down.
market?
Yeah, the bond market, especially since we see with Fed independence questions, sometimes we see those spike in long-term
And are
yields.
you in the camp that 30-year above 5% is a bad thing for stocks?
Let me do both questions, because those are both very important questions. I think the bond market, I watch the 2 versus the 10-year spread very closely. And it's been in a very tight range, pretty much 40 to 60 basis points, rock solid.
It's boring now.
It has gotten boring. Now, historically, that's still rather low. That number can easily double or triple and still be within relatively normal historical ranges. And you could also argue it might be difficult to see them going back to an inversion. On the flip side, though, that's partially because the 2-year is pricing in a series of rate cuts, which the 10-year is not. So a lot of it will have to do with perceptions about inflation, and so far they seem to be relatively contained. But at some point, you're right. If rates go too high, they have to impact stock prices. Not necessarily in the short term, because I'm a lot of the people who are chasing momentum are not necessarily doing a discounted cash flow.
But it reveals some bigger picture issues, maybe the debt and some other things.
Well, if nothing else, right, the stocks in theory are based upon the present value of the future cash flows. You could do cash flows, you could do earnings, you could do dividends, whatever. But some sort of future flows of funds that one could expect from the stock. Well, if that discounting rate goes up, and since stocks are essentially infinite assets, you use the longest possible rate to discount it. At some point,
now it's 30, or it could be 100.
It could be. And I've been sort of joking around using there's a continuum between disciplined analysis of future cash flows, and on the other side is flight to crap. And I think we were sort of getting a bit toward the other side. Yeah.
Not to be confused with flight to safety.
Well, it's meant to be the inverse of that.
The inverse of it.
And this is a great place to pause for a little commercial break here. But coming up, we are going to be talking Jackson Hole and Fed policy, plus a volatile runway showdown that pits smart money against the herd. Stay tuned. This episode is brought to you by the lucky number 7. That's how many Jackson Hole meetings Fed Chair Powell has under his belt. And you can bump that up to 8 this year, which will be his last. And I don't think anyone is expecting Powell to rock the boat here, so maybe we're not going to get a lot of market-moving things, but let's talk about the Fed in general and where you see them right now. Markets are pricing still a couple rate cuts. September seems to be that first month or the next month that we would potentially see them. So do you see this happening? Do you think it's a good thing or a bad thing for markets?
I think the market's right to put a relatively high probability on a rate cut in September, but it's not a foregone conclusion. And I'll tell you why. Politically, obviously, there's a lot of pressure for it. You may or may not have the new Stephen Miran approved to the new seat, to the open seat by then. He would probably be one of the people pushing for a cut. I think you also have Waller and Bowman clearly pushing for cut. I think they are participating in the Apprentice Fed edition, lobbying for that job of chair. But so I think they're pushing in that regard. But I think Powell is going to stress data dependence in his speech, and you have a fair amount of data coming out between now and September. We have another read on jobs, which, to be, obviously the last read on jobs was shocking for its revision. I was actually on air here, and I'm just sort of like, I don't know if the camera caught my jaw drop, but
I'll have to have a Steve cam next time. Just in case.
I think it caught the other. I think it caught the others by the same amount of surprise. I'm not unique on that one, but that was stunning. So the question is the labor market weakening? And remember, the Fed's dual mandate is stable prices and maximum sustainable employment. Well, we could argue that at a 4.2% unemployment rate, we're probably closer to maximum sustainable employment than not. But I'm not going to object, nor do I think many would, if the Fed does something sort of, little preventative medicine against that. On the other hand, stable prices, and that's really much trickier. because we're going to have core PCE, we're going to have CPI, and we're going to have PPI.
And the Fed interprets stable prices to mean 2%, and we're above that right now.
We've been above that. Obviously, the PPI number was shocking last week. And
Another shock, yeah.
And
High.
I happened to be, I was a little out of my element. I happened to be on the floor of the exchange that day because I was...
Maybe you didn't have your terminal or something there.
Exactly. So I didn't have my usual news services. I was fortunate to, be invited to participate in the MIAX IPO.
Oh, cool.
Which was really cool, I got to say. But so I was like, why isn't the market reacting to this? Because I'm occasionally getting things on my phone. I'm seeing stuff go by, and it's like, why is stocks not caring? Bond market cared to that point. The bond market gave back. The bond market gained on last Tuesday because it liked the CPI numbers. They're in line, but in line was good enough for a bit of a rally. And then on Thursday, bonds gave back everything. Stocks displayed what I'm calling that ratchet effect now, where they go up big and don't really come down as much because of the relentless dip buying, and that's what we saw on Thursday. So I then went back and looked at what's going on with core PCE, which is the Fed's preferred inflation gauge, and CPI. All three have risen in the last 3 months. So on a lot of economists like to annualize the last 3 months or 4 months, and so I'm not an economist, so I'll just.
But you can still do it.
I can still do it. I can.
Just see the formula.
I can do averages just as well as anybody else, or annualize. And what happens there is, so those numbers are annualizing to something above 2%, but below 3%. But they've been going up each of the last 3 months. And it's not clear still what the effect of tariffs might be, because it's literally been, I think it's still under 2 weeks since the tariffs were fully implemented. And we still don't really know what's going on with Mexico and China. So I think Powell is likely to preach data dependency and caution. He may not, and to a certain extent, I wouldn't blame him if he came out basically hawkish, just psychologically, like, you know what, this is you being the president. Stocks would
not like that.
No, stocks would hate it, but you being the president, bash me at every opportunity. I'm going to push back and tell you why I'm not buckling under right now.
And to that point, there's been this hawkish tilt, I feel like, with Powell. Yes, he's been a little more neutral, but he hasn't totally leaned into the Dove camp either. And when I was looking through the CPI prints, what stuck out to me, what I've been hearing from economists, is that services inflation is now getting sticky again, and that had been offsetting some of the rises that we saw in goods inflation.
Rotation within the economy.
And that maybe says that something more sinister is going on below the surface, because services isn't directly tied to trade policy. Of course, there's that ripple effect if businesses are absorbing a lot of these costs. But how are you looking at that, services versus goods inflation, and does that spell bigger trouble for the Fed?
It could, and actually that's kind of why I'm surprised that the yield curve has been in such a relatively stable range, because there are sort of inflationary concerns bubbling under the surface. I think we're not at an acute level yet, and I think to the market to some extent, despite the reputation of bond vigilantes, I do think there's a little bit of don't fire until you see the whites of their eyes when it comes to inflation. So I think right now it's still in the watch and wait category to some extent. But again, I think this is why you're going to get a little bit of a public pushback from Chairman Powell about why he's not just pedal to the metal on rate cuts. And also, by the way, keep this in mind, the market has been ahead of the Fed for years.
If not decades.
If not decades. Think back to the beginning of 2024, right? We were 7, maybe 8 rate cuts. We got the equivalent of 4.
I think we're fine, 20% plus at the year end.
And we did just fine, thank you, because it is my contention all along that rate cuts are nice, and traders have been conditioned to want rate cuts, but you still want a strong economy. And we got
why of it all.
You got a strong economy in the midst of all that. And I think right now they want the strong economy too. But even here, the all year, the market's been anticipating rate cuts that have yet to materialize.
All right, good time to pivot now to our runway showdown, which is all about volatility, Steve's wheelhouse. I need to first mention that Steve here is somewhat famous for saying that the VIX Volatility Index is not a fear gauge, though many investors and those in the media call it just that, a fear gauge. As he points out, the VIX is measured through S&P 500 options activity 30 days or a month out. That's the time frame of institutions, or smart money, as they say. And guess what? That is who's strutting down our left catwalk today, the 30-day VIX, reflecting all that institutional hedging activity when uncertainty knocks. But we do have a measure of volatility that's based on S&P options only 1 day out, which is more in line with the time frame of retail investors. And this 1-day VIX is now skipping down our right catwalk, reflecting all those 0 days till expiration options contracts that sometimes go up in smoke. So assuming you accept all of my premises here, Steve, my question to you is, who's wearing a better gauge of market risk today? Is it the 30-day VIX reflecting smart money, or should we be watching the 1-day VIX, taking warning signals from the so-called herd?
Can I give a C? The 9-day VIX.
Oh,
there's
beautiful.
There's a VIX 9D, and I've actually been sort of curious as to why this has not been reflecting more. They're all the same constructions. VIX 1 day, of course, is using options with an average of 0 to 1 days till expiration. The VIX, which, customary old VIX, is options actually with 23 to 37 days to expiration, so averaging 30 days. So it's a one month look ahead. The 9-day has an average time to expiration, uses S&P options with an average time to expiration of 9 days. Well, let's think of what might be coming down the pipe in the next 9 days. You have Powell's speech on Friday, which we've laid out scenarios as to why it could be benign or why it could be volatility inducing. We also have NVIDIA earnings within the 9-day period. And yet the VIX 9D is yawning relatively. And so that's not pricing in. So it's still telling us that despite these couple of days of pullbacks, markets are not really looking for volatility protection. So yes, you've used my phrase, VIX is not a fear gauge, but it plays one on TV several times, or in podcasts, as it were, or in streaming media, as it were. But basically, what it is in many ways is a proxy for the demand for volatility protection.
Really interesting. And I will say this, anytime we can end on a wonky discussion of the VIX, it has been a good podcast. And also just thinking about some of the other things we learned, we talk about rotation in the market and with sectors and industries, but we can also see it in inflation. We touched on that a little bit with the goods versus services inflation. And of course, we have the Fed here. No big expectations for Jackson Hole, but huge expectations for who's going to fill that the potential vacancy now that Cook is under fire a little bit, and just kind of gaming out those September possible rate cuts. So we have officially wound things down here at Stocks in Translation, and we will see you next time. Make sure to check out all our other episodes of our video podcast on the Yahoo Finance site and mobile app.